Good evening, class, and welcome to our advanced taxation class for today. So I want to believe that everybody is seeing my screen. So I'm getting feedbacks. We've not started. I'm getting feedbacks. Let me see your feedbacks. My voice is not audible enough. This is serious, very serious. Okay. I just hope the voice audible because I'm almost shouting here and I'm not using earpiece. So I believe someone should hear me, or maybe you could use an earpiece so that you could hear me well. Okay, so let's get back to class. Taxation of residents, of non-resident,
Tachima, I can't hear you. The voice is going to, I'm hearing from far, far, far. I can't hear.
I am just right in front of my computer, very right in front. If I use earpiece now, you will say you will not hear me. Let me pause the recording.
The thing is fainting. That's what I'm saying. It's you are as if you are talking from a very far distance.
Okay. So our topic for today is taxation of non-residents. So what are we standing to gain from this lecture? Here are some of the things we will know. We will know what a non-resident individual is and a resident individual. Who is a non-resident? What's a non-resident company and a resident company? And what do we mean by dual residence? They will be thinking about how to tax these entities. So let's go now to the meat of the whole topic. Now, the concept of residence is very much important to taxation. Now, if I ask you, where do you reside? Or give me your residence address, you will likely tell me where you sleep and wake up every day. You will likely tell me your home. Now, some people, when we ask your place of permanent residence or your permanent residence, some people decide to put their village address. And when you look at this, they don't stay in their village other than 2 weeks in a whole year. They may be in Lagos for 11.5 months. And when you ask them their permanent address, they are giving you village where they are not living. Okay, so we will be saying what we mean by residence. Now, it is very, very important when it comes to taxation, because to a large extent, the income of a taxpayer is liable to be charged to tax where he is resident, or where they call tax jurisdiction. In Nigeria, when we talk about a resident person, we mean two things. We mean a resident individual, or we mean a resident company. Both of them are called resident person. So a company is a person because a company can stand alone. a company can be sued or can sue. And so the company can have a personality of its own. And so a resident person is an individual or a company. Now, a Nigerian resident person is accessible to tax on the global income. Now, remember when we learned special businesses, we talked about worldwide income. And these are income not gotten only from Nigeria, but gotten from other parts of the world. Now, when we are talking special businesses, we are looking at businesses that are not incorporated in Nigeria. These businesses, we call them non-resident persons. Now, in this topic, we are looking at non-resident individuals. But before we go there, we need to know what is a resident person. A resident person is a person who resides in Nigeria or a company that is incorporated to tax in Nigeria, incorporated in Nigeria. And this implies that a taxable person is liable to tax on all the income or profits that he makes, no matter where he is in the world. And he brings it into Nigeria. Okay? And so whether he makes it in Nigeria or not, as long as he's bringing it into Nigeria, it is going to be taxable in Nigeria. Now look at 3 characteristics of a resident individual. Now this is an individual, not a company now. An individual is said to be resident in Nigeria throughout an assessment year. So now an assessment year is the government fiscal year, which starts from January 1 and ends in 31st December of a year. Now, for a particular year, say 2014 that has just passed, sorry, 2024 that has just passed, if a person has these 3 characteristics for that year, he is resident in Nigeria for that year. 1, he is domiciled in Nigeria. When we say domiciled in Nigeria, it means that the person lives in Nigeria. So we say, for example, if you go to bank and they say, where is your account domiciled? That language, where is your account domiciled, means where did you open your account? Which branch? Okay, that's just to explain what is domicile. So if the person is living in Nigeria, he has a house address in Nigeria where he wakes up every day in Nigeria. He is domiciled in Nigeria. For example, many of us here in this class are domiciled in Nigeria. And so we are Nigerian residents. Now, the second part is, if you are not resident in Nigeria, you sojourn. That means you come and you go, you come and you go. And all the period of time you stayed in Nigeria, it is not less than 183 days. It hits 183 days or more in the 12-month period. So it means that, let's say you come to Nigeria, and I'm using a case of, let's say, a footballer who plays ball in Nigeria. He may not be a Nigerian-born person. Let's say he's a coach, foreign coach. He's not a Nigerian origin. Now, this man stays here January till March. That's 3 months. And he goes to his original country and spend 2 months. He comes again. That is, he comes in June and spends June, July, August, September. 4 months again, adding to the 3 months. That's 7 months. He has spent 183 days and above. And so for that period, once he clocks 183 days, he is seen as a resident person. Now, the question you're asking is, why 183 days? What is so significant about 183 days? Now, let's do the maths. In a typical year, we have 365 days, right? Now, if we were to divide it by 2, 365 days divided by 2 is 182.5. Meaning that 182.5 days is exactly half of the time you spent in Nigeria. So if you spend 183 days, it means that you have spent more days in Nigeria than anywhere in the world. Imagine if there are 366 days and you divide it by 2, that's 183 days. So it means that on a leap year, if you spend 183 days in a year, for that year, you spend half of your time in Nigeria. If it is in a non-leap year, it means that you have spent 1 day more than half, meaning you have spent more days in Nigeria than anywhere in the world. And so Nigeria becomes your residence, because this is where you usually stay. You spent more days in a year for that year. So 183 days is sacrosanct. Now, the third definition is you serve as a diplomat or diplomatic agent in Nigeria. So what it means is that you serve as a diplomat for Nigeria. So when you serve in the embassy, let's say you are serving the Nigerian embassy in Ghana. Now, that embassy is seen, even though it is in Ghana's territory, that embassy is seen as Nigerian territory. So it means that if you are serving as an ambassador of Nigeria in another country, you are a resident individual. Now, look at this. If a United States ambassador representing US in Nigeria is in the US embassy in Nigeria, does he participate in election in Nigeria? He doesn't. Will he participate in election of the United States? Of course he will. And if there's anything that happens, you can't arrest him in the embassy. If you were to do anything against him in the embassy, you would have incurred the wrath of the United States, because that is also seen as their ground. So for diplomatic agents, you may not physically be in your Nigerian's territory, but because you are a diplomat representing your country elsewhere, you are seen as a resident individual. And so we could say that if you do not meet any of these, you have to meet at least one of these for you to be a resident. You have to meet at least one of these. So if you happen not to meet any of these, then you are a non-resident. Now, resident individual and tax liability. Okay, so the profits of a trade. So it means that if you are buying and selling, you own a shop, or you are an accountant, you are a lawyer, and you are in Nigeria, and you are doing it in Nigeria. Now, regardless of whether you have stayed 183 days or not, your profit will be charged to tax. So it means that, look at our coach that is coaching the Super Eagles, foreign coach, right? He's a foreign coach. If he decides to own a shop or decides to, run a business, that business is giving him profits. So whether he stays 1 day or 183 days, the profit from that business is charged to tax. But now, when we talk about residency and tax, the residency rule apply mainly to employment income. So it means you are a salary earner. So if you are a self-employed person, you don't fall under the residency rule of 183 days. But if you are a salary worker and you are earning your income in Nigeria, if you are not resident in Nigeria with these characteristics we described above, then your income or your salary will not be charged to tax. So on the day you become residents, then all the income for that year will be charged to tax. Okay, so non-residents. We've talked about non-residents. A non-resident is anyone who is not domiciled in Nigeria, or if he comes and goes in Nigeria, he is not staying up to 183 days. But he derives income or profit from Nigeria. Now, when we say derive income or profit, we are talking about employment income. Now, a non-resident individual becomes liable to tax the day he carries on trade in Nigeria. And so once he opens a business name and carries on trade, or he started to practice his accountancy or law practice, he is liable to charge the tax on that day. All right. But I said before, he is not taxed on his employment income. All right. So let's go. All these are repetition. Now, resident and non-resident companies. So we have talked about individuals. We said resident persons could be individual, could be company. Now we've discussed individuals. Let's talk our attention to companies. Now, a company is seen as resident in Nigeria under the extant law of Nigeria if that business, if that company, I won't call it business because company is strictly limited or PLC. If that limited company is incorporated or registered in Nigeria. So registration gives a company the status of residency. And so if CAC gives you your certificate and you have an ROC number in Nigeria, now whether you are not originally from Nigeria, but your company is registered in Nigeria, or you call it incorporated in Nigeria, it is a Nigerian resident company. But you yourself, as an individual, might be a non-resident individual, but your company is a resident company. Now, under the old provision, previously, residence was determined by the place where management or control is given. Let's say, for example, many companies are having their head office in Lagos, right? And they have branches in all over the 36 states. Let's say the banks. I'll give an example of Zenith Bank. Just as an example, the head office, the corporate office is in Lagos, and it is controlling or managing the activities of every 36 states branches. And so residence is seen to be in Lagos. So that is why when you are filing VAT, you are filing it under, they'll be filing it as one under Lagos. When they are doing withholding tax for the company, it is being withheld under Lagos. When they are doing everything, take it to the head office, because that is where management and control is centered. Now, let's assume that this is a multinational company, and the multinational company has its seat of management in Nigeria, but have branches all over other countries. Then the place of management is in Nigeria, and under the old provision, it is seen to be a resident company. Whether you register it in Nigeria or not is immaterial, but where is control coming from? And that's the old old provision. So this means that a company can be resident in Nigeria by incorporation and also resident in UK if it is managed and controlled in UK. So you can see here that there is something called this definition now, where you use incorporation and you also use seat of management, makes you have something called dual residence. It's just like somebody that have dual citizenship. But now in this case now, somebody is having dual residence. This is a company having dual residence. You are resident in Nigeria by way of registration, and you are resident in another country by way of management. Now, non-resident companies. This is a company or corporation that is not registered or incorporated in Nigeria, but they derive their income or profits from Nigeria. Now, when we were talking about special businesses, we see that we divided our income into Nigerian income and non-Nigerian income, isn't it? Yes. So now these companies, we talked about people in the airline, people in the telecommunication, and when they are not registered in Nigeria, they are not incorporated in Nigeria, maybe we could think about these South African companies that are operating in Nigeria, let's say MTN, MultiChoice. They are not incorporated in Nigeria, but they derive their income or profit from Nigeria. Now, by the singular fact that registration or incorporation was not done in Nigeria, it makes them non-resident. So for emphasis sake, the exemption from incorporation does not mean exemption from tax. So it means that whether you are incorporated in Nigeria or not, the fact that you derive income from Nigeria, you must pay tax. For those that are resident companies, it is easy. This is because your worldwide income will be brought into Nigeria. And so whether you do nothing in Nigeria, you didn't do anything in Nigeria, all your activities were carried out in Ghana, in US, in London, you will bring the income to Nigeria and consolidate. You will pay tax on your worldwide income. But let's look at non-residents. They do things in Nigeria and they do outside, but they are not residents in Nigeria because of incorporation. And they are going to repatriate all their monies out from Nigeria. But before they get it, they are going to pay tax. And so the exemption from incorporation or registration does not mean exemption from payment of tax. The following are the circumstances under which a non-resident will be liable to tax in Nigeria. Now look at these circumstances and see each of them is a proof that you have derived income in Nigeria liable to tax. One, income is derived through a fixed base or permanent establishment. Now that means, let's say you have an office or yes, an office where you operate from. That's a fixed base. So if that fixed base is there, can be established, then income is derived through that fixed base. Now that fixed base could also be, okay, we'll talk about the second one. I wanted to say that fixed base could be an agent, but agent is discussed in number 2. So that fixed base is a place where you conduct your business, permanent establishment. Then you derive your income in Nigeria. Now you could think about MTN. They have fixed base in Nigeria. Even if they don't have, they have a mast in Nigeria. DSTV, MultiChoice, they have a stake here in Nigeria. But now look at Meta. That's Facebook, Instagram, and then WhatsApp. Do they have a fixed base in Nigeria? No, I don't think so. What about the owners of YouTube, say Google? Maybe by now they would have had a fixed base in Nigeria. But what about Zoom? The owners of Zoom likely do not have fixed base in Nigeria. What about TikTok? They are not fixed base in Nigeria. All right. Now, income derived in Nigeria through a dependent agent. So the key word here is dependent agent. So who is a dependent agent? A dependent agent is someone whose income is dependent on his principal. So it means that there are 2 kinds of agency. You could be a dependent agent, you could be a non-dependent agent. So a dependent agent, you go as you do as you are told. Now let's say, for example, you have an accountant. An accountant is sent to any of the branches to go and do any job for the company. The company takes him to anywhere they want to, and they give him his salary. No commission, no nothing, his salary, or is dependent on that stipends coming from that principal. That person is an independent agent. Now, an independent agent will be someone who is a freelancer. He goes there, does his job, they pay him, and he goes. He does it on his own name. Nobody is his principal. And so when there is a principal-agent relationship, that is a dependent agent. But when you are doing it as a vendor, you are a freelancer, you are an independent. And so if an income is derived from a dependent agent, so it means that the company is not in Nigeria. There are no fixed base in Nigeria, let's say Facebook as an example. But if they have a dependent agent, a sales agent in Nigeria, through whom they conduct business in Nigeria, then the presence of that dependent agent in Nigeria replaces the fixed base. And so it becomes taxable to Nigeria. Income derived from supervisory activity that lasts more than 3 months. So it means that if it's lasting less than 3 months, it is not taxable. Income derived in Nigeria from a turnkey project. Then income derived by non-resident company from professional consultancy. So if you are a non-resident and you are a professional consultant in maybe in accounting, in law, management and technical services rendered in Nigeria, you will be liable to tax. Income derived by a non-resident company from investment, such as the dividends that they get. So any dividends that they get from Nigeria's investment. So you're a non-resident company like MTN, and you invest maybe in a company like Dangote, that is a Nigerian company. Now that investment will pay you dividends. Such dividends will be deducted, will have withholding tax deducted from it. And that withholding tax, let's say the withholding tax is 10%, that is the final tax. That is the only tax that that investment will suffer. Okay, now let's say the MTN company decides to give out loan to Dangote instead of buying shares as investment. They decide to give out loan and they are paying and they are receiving interest. That interest is taxed withholding tax of 10%. It becomes the only tax that it suffer. Now, if it has to rent any of its equipment or any of its facilities that is put out for let, this is an investment. So dividend income, interest income, rental income, royalties are all investment income. So any income derived by way of investment, the withholding tax is seen as the final tax. Then income derived from a contract awarded to Nigerian company, but now it was subcontracted to a non-resident company. So because it was awarded to a Nigerian company, you being subcontracted, it's as if you're working for the Nigerian company and you are like an employee to be liable to tax. Now, though it may be said later, because of the Finance Act 2019 and 2020, a term came to be known called significant economic presence. Now, because some people could escape all of these criteria from A to G, they could escape. The likes of Zoom, the likes of Meta, and all these software companies like Kaspersky and all of that antivirus, they may escape some of these. I'm just using this as an example So what happens? The Nigerian government now said, if you will exert economic influence in Nigeria, it means you are economically present. So they now put something called significant economic presence. So it means that for you to have significant economic presence in Nigeria, your revenue derived from Nigeria should not be less than 25 million. 25 million naira. Now look at all the people that uses Facebook, people that uses Gmail, people that go to YouTube, people that have a Zoom account. These lectures we are having here is made possible by Zoom. You can stream your lectures by YouTube, but they are not here in Nigeria, but they exert a significant economic presence in Nigeria. And so that phrase makes them taxable to Nigeria. Now, before I forget, we talked about residence and origin. Now, origin is not as important in taxation as resident. Let me give you an example. Let's say a Nigerian-born player, maybe from Delta State of Nigeria, is a Delta-born player in Nigeria, and he is in a foreign club, maybe in Brazil. He plays for Brazil, and he stays there most of the time. He is a resident of Brazil, although he's a native of Nigeria, but a resident of Brazil. Never a resident of Nigeria. Like we can say those in the diaspora. Those in the diaspora earn their income in the diaspora, but they don't pay tax here in Nigeria. This is because origin is not as important. But now look at our coach. He might be a German coach, German by origin, but he is in Nigeria, domiciled in Nigeria, earning his employment income in Nigeria. And so he is seen as a resident person and liable to tax. Whereas the Nigerian-born player that is outside is seen as a non-resident. And so don't confuse origin, state of origin or country of origin. Don't confuse it with residence. And what is more important here in taxation? Residence, never origin. Now let's talk about dual residence. Dual now means two. So when an individual have two or more residence status, the person is seen to have dual residence. I just give an example, like someone who has two international passports and is resident in two or more places. So that's it. Now, the idea of dual residence of local individual give rise to something called principal place of residence. Now let's see. For someone who have houses in Lagos, Abuja, and Port Harcourt, he resides in these three places, right? He lives there. He has houses where he sleeps and wakes up. These are not just hotels. These are places where either he pays rent or is the owner of those houses. And so he sleeps there, wake up, he lives there. But the thing is, among all these places, there is one place where he stays more than any other place. That place is called his principal place of residence. It's the principal place of residence. Now, in the case for individuals for tax purposes, a principal place of residence for people who have earned income. When we say earned income, what we mean is you go to work and you earn your income. If you don't go, you won't earn. For example, employment income is earned income. If you don't go to work or if you're not employed, you will not earn your income. Another earned income is business income. If you don't conduct business, if you don't go to your shop, if you don't go to your online shop, if you don't make sales, you cannot earn. And so this is earned income. So for individuals with pension as their only earned income, so that means you are having only pension, your place of residence, your principal place of residence will be where you usually reside. So it means where you stay the most. So I'll give an example. Now, let's say in a typical week, somebody spends 3 days in a week in street A. Let's say he has 3 houses. 3 days in a week, he spends it in street A. 2 days in a week, he spends in street B. And the other 2 days, he spent in street B, in street C. The place where he spends 3 days, that is where he spent most of the time. So in the case of places, people that are having different residence, where you spend most of your time in a year, that becomes your usual place. Now, for those that are earning under earned income, except pension. So a pension, you don't go to work, you are at home. And so where you stay most constitutes your principal place. But if you're not a pensioner, but you earned income, it's either you go to work or you do business. Now, the place that is usually nearest to your place of work, the place of work is important. So where your place of work is situated, that is your principal place of residence. Now look at it. How many hours do we spend at work? Some people spend a maximum between 8 to 10 to 12 hours. Now imagine somebody spending 12 hours at work. Where will he spend the remaining 12 hours? Sometimes on the road, you spend some part of it. How many hours do you spend at home? You spend less time at home and more time at work. Even if you are just spending 8 hours at work, you are spending more time at work when you are when you are actively up. You spend most time at work than any other place. Yes, you might say, I sleep at home and I spend 8 hours sleeping. No, that doesn't count. And so you see here that if you have earned income, your place of work becomes your place of principal place of residence. Now, if you have unearned income, meaning that you have dividends, interest, royalties, rent, your money works for you. You don't go to work before you get paid. Your money works for you. And so your principal place of residence will be where you stay most of the time, just like pension. Now, where the determination of principal place of residence leads to disputes between two or more tax authorities, the joint tax boards will determine the tax jurisdiction. And in doing so, the determining factor is the source of the earned income. Now, a case in point here was where there was this this person, what's his name again, that won the Big Brother one time. Okay, yes, Lekon. And Lagos State was saying he is a Lagos resident for this game. Ogun State says no, he's an Ogun State. Is it Ogun State or Oyo State? I've forgotten. So there was a dispute as regards his place of residence. But the thing is this, where is the income being earned? So if it is earned in Lagos, although he went there to play a game, so he's seen as a Lagos resident person. So that's what we need to take note of. So we have seen dual residence in individuals. And when you have more than one places, one of them will be where you reside most. That is talking about unearned income and pension. Then your place of work or business is where you spend most of the time in the case of earned income. Now let's look at companies. Dual residence of a local company. Now when we say local company, these are companies that are registered in Nigeria. The constitutional arrangement in Nigeria vests the taxation of all companies in the federal government. So that means that the FIRS is the one that is vested with taxing all companies. So it means that if you register a company in Nigeria, limited company, it means that your residence in any states of the federation does not matter. The fact that you have registered and you are in Nigeria, you are a Nigerian. And so the law does not allow for dual residence of companies locally. So you cannot be saying that my office is located in Lagos, I'll be paying my tax to Lagos state government. And the other one will say, no, I want to pay to Abuja or Port Harcourt. The federal government takes it for all companies. This is not a business name. Okay? All companies, wherever located in Nigeria, are under the federal tax jurisdiction. And so the problem of dual residency does not arise locally, because whether you are in Lagos, you are in Port Harcourt, you are in Abuja, we are within Nigeria's confines. And so you are a Nigerian resident. Now, when it comes to international presence, that is where we now have dual residence issues. Now, the definition of the term residence differ from country to country. So because of the definition, we have seen like some people will say that residence has to do with management and control. Now, in Nigeria, the length of stay of a taxpayer as a residence is reckoned within a 12-month period. In some countries, this is reckoned within an assessment year, allowing for a qualifying period of stay to be split over 2 years. In some countries, like in USA, the citizen is regarded as resident in the home country, whatever the length of stay abroad. So it means that if you are a citizen of US and you are living outside US for even 10 years, you have not come to US, you are regarded as a resident. And so for some people, how do you gain citizenship of US? The moment you are born in US, in any hospital in US, you are born in US, the child becomes a citizen of US. And as a citizen of US, when you come back to Nigeria, you are still a citizen of US. You grew up in Nigeria, 5 years, 10 years, you have not gone to the US. You are a US resident. Now the mother it's not necessarily a US resident or a US citizen if she didn't get citizenship, because it's not automatic. But for children, it is automatic when they are born there. And do you know that when you are of age, let's say 18 years, the US government starts taxing you because you are a resident wherever you are in the world. You have not smelled your feet to the US after your birth, but because they have a record that you are a resident, you were born there, you are a citizen, and the citizenship confers you residence, you will be taxed. And so some people that goes to born their children in the United States, they may not know this, that when their children reaches of age, they are start being liable to tax, and they may not know. Okay, so this problem of non-uniformity of the meaning of residence creates a problem. It creates one problem. So, for example, one company or person can be regarded as a resident in Nigeria because he is domiciled in Nigeria for 183 days. And another person, and that same person can still be regarded as a resident of United States by virtue of the fact that he is born in United States and has a citizenship in United States and is in Nigeria. So he now has two residents. One Nigeria, because he's still there, he has not left Nigeria, and another US. So there's a problem. A company may also have the same problem of residence. For example, one definition makes a company resident by place of incorporation. So it means, let's say Globe, Nigeria, was incorporated in Nigeria. So that makes Globe a resident company. But if Globe moved their head office, let's say to the United States, and they control from there, management is sitting down there. Now that in itself makes Globe in that country a resident country because management and control is taking place from there over Nigeria. And so Nigeria sees him as incorporated in Nigeria, so there's residence there. So he has two residents. Okay. So in this instance, how will we solve this problem? The Nigerian tax treaties govern the treatment of such cases, and affected companies can claim something called tax credits for the Nigerian tax in their home country to avoid double taxation. Now, after this particular lecture, we will be doing something called double taxation. So, but it is pertinent for you to learn this in preparation for that topic. Now, we've seen that in Nigeria, There is a resident person who is an individual or a company, and we've seen the meaning of residence as a person, 3 characteristics, residence as a company by way of incorporation, and we can see that there will be dual residence. Something could happen that dual residence may happen on an individual or on a person, and it creates problems. Now let's look at something called branches and parent company. Branches. So we know branch, parent company. Now be consistently using one company now. Let's say Zenith Bank. Zenith Bank, Nigeria, might be incorporated in Nigeria and becomes the head office, parent office. Now the tax law of some countries, like let's say the Zenith Bank decides to go to other countries, like 5 countries. The tax laws of some of those countries may regard that branch as residence for tax purposes. So it means that the parent company is in Nigeria. Let's say the branch is in US. They may regard that branch as a resident company. Now, there is no such provision in Nigeria whereby a company is registered outside but has a branch in Nigeria. That branch in Nigeria is not seen as residence, because for Nigeria, for you to be resident, you must be registered in Nigeria. Now, this is what we call foreign branch in Nigeria. Now, look at this now. A Nigerian branch of a foreign company. So let's look at it again. Nigerian branch of a foreign company. So let's look at the company here. This is the, let's say this is Zenith Bank. It's in USA. So this is the parent. They decided to open a branch in Nigeria. So this is Z in Nigeria. So this is a branch. So this is called foreign branch for Zenith, because the local branch is US, because it is incorporated in US. So Nigeria become the foreign branch. So a Nigerian branch, which is this, of a foreign company is treated as a corporate entity under the law. So this means that this Zenith Bank Nigeria is treated as a corporate entity under the law. And any income or profit that is derived from this independent branch is taxable. Now, there are 2 conditions where it may not be taxable. Now, if the branch is used for collecting, storing goods, or to display, so it's like a showroom, sales doesn't happen there. It's just for show. Then, the branch is also used for collecting information only. So in that case, it may not be treated as taxable. But when there is a foreign branch in Nigeria, if there's a foreign company having a branch in Nigeria, that Nigerian company is a foreign branch. No, sorry. That Nigerian company is a Nigerian branch of a foreign company. So the company is foreign, the branch is Nigeria. So Nigeria will not, Nigeria will treat it as a separate entity. So any foreigner that registered his business outside but brings it to work in Nigeria, let's say MTN Nigeria, DSTV, they are all in Nigeria, they are seen as Nigerian branch of a foreign company. Now, this Nigerian branch are taxable to tax. Now, we look at another one, subsidiaries and parents. So let's see subsidiaries and parents. What is a subsidiary? A subsidiary is what will I say? I want to use FRCA definition. When a company is being financed by another company, that company that has the majority of the share is a parent company, and the people who have the minority are the subsidiary. So a parent company will hold at least 51%, whereas the subsidiaries are holding less than 50%. So a subsidiary is expected to be incorporated in Nigeria. So it means that if there is a subsidiary of a foreign company inside Nigeria, now this is different from branch. Now, what's the difference between branch, Nigerian branch of a foreign company, and a subsidiary? Now, if we have Zenith Bank London, Zenith Bank Nigeria, this is one company, but two different locations. This is an example of a branch. So the name is still retained. The name is still retained. But subsidiary, they have different name. Let's say Zenith Bank Nigeria and Dangote, maybe Dangote Toothpick is just coming up. Or we can say FCA Toothpick is just coming up, and there are subsidiaries, and we find out that the parent company, Zenith Bank, bought more shares. So it's see here, it's possible that 100% equity will come from the parent, or some subsidiary might have some parts. So that is different. The subsidiary is expected to operate as a separate legal entity. They are expected to be incorporated in Nigeria. And the foreign equity participation may be 100% or less. Now, the ownership of the control will not affect the residency status in Nigeria. Now, let's see comparison between overseas branch and overseas subsidiary. Now, overseas branch, meaning that head office is Nigeria and branch of the same name. Zenith Bank Nigeria happens to be the head office. Maybe Zenith Bank London is a branch. They have the same name, but they are located in different areas. Now, for the tax purposes, the profit of overseas branch of a Nigerian company, the profit is deemed to be made in Nigeria. So all the branches, be where they are all making and deriving their income are seen to be derived in Nigeria. That means their worldwide income, wherever they are as branches, all their income worldwide is brought to Nigeria and being taxed. Now, what is overseas branch? Nigerian is the head office and overseas is the branch. So everything is being charged to tax in Nigeria. Okay, so this is different from parent. Branch is Nigeria, whereas head office is outside Nigeria. If branch is in Nigeria, only the activity of Nigeria will be taxed, whereas the worldwide income of that foreign um, parent company, or will I say head office, everything will go there. Now, when we talk about subsidiary, overseas subsidiary, and local subsidiary, means that there are different names. Somebody is in London and is a parent, and they incorporate incorporate a company in Nigeria. That Nigerian company becomes a subsidiary, right? That subsidiary in Nigeria is liable to tax. But for the purpose of taxing, if the overseas is the subsidiary while the parent is in Nigeria, since the subsidiary are having different legal entities, so the foreign um, income is not deemed to be derived in Nigeria and will not be subjected to tax in Nigeria. Now, treatment of expenses. The Nigerian tax law do not discriminate between residents and non-residents when they are treating allowable expenses in order to determine taxable income. So the way Nigerians are being treated is the way they treat non-residents when it comes to calculating their allowable expenses. Now, profit or income deemed to be derived from Nigeria. Now, under the old law, the liability to the Nigerian tax on the income from trade of a non-resident company was restricted to that portion of the income. But now, it has been found to be inadequate. So, what did they do now? The government is in favor of encouraging foreign investment. And so they decided to state in clear and specific terms which activity of a non-resident company would attract Nigerian tax and to what extent they will be attracted to Nigerian tax. Now let's talk about transactions not at arm's length. We mentioned it the other time that when there is a controlling interest between two companies, the transaction between them may not be arm's length. We talked about definition of arm's length the other time. And so when there are two people, one person having two places where it's controlling, or when there is an indirect control, not directly, maybe you buy shares from one company and the other company buys shares on the company you are planning to control. And that company is the major shareholder and you are the director or controller of that company. So in that way, we wield a lot of control. And so all this is still reiterating all what I said before. Then, basically, non-residents, the meaning of non-resident versus the meaning of residents. We have also seen, both for company and for individuals, we have also seen when there are two residents, what is the principal place of residence for both individuals and for companies. We've looked at Nigerian company as the parent. Then there is foreign company as the branch. The same name. Since the parent is in Nigeria, all the income from worldwide is coming to Nigeria to be taxed. But if the stone is flipped, Nigeria is now the branch. Head office is located somewhere. So it is no longer a Nigerian company. And so only the business that is done in Nigeria gets taxed when it is being repatriated. Then we talked about when there is a subsidiary. The subsidiary, there is no two names that are the same. So let's say one of them is FCA, the other one is Go Getter. And FCA is the parent, Go Getter is the subsidiary. Now it means that if FCA, which is the parent, is in Nigeria and Go Getter is in London, it makes Go Getter a foreign subsidiary. Now, because they are foreign subsidiary, there will be less control in terms of jurisdiction, in terms of legal person. And so anything that is happening there, it cannot be taxable to tax in Nigeria. But if it is Nigeria that is the Nigeria is the how will I call it? Is the branch or the subsidiary. And another country, let's say the US, is the parent. Nigeria can only tax only what the parents had done in Nigeria before they move the profits to wherever the company is. And so this is it. We've come to the end of this particular topic. And so this is in preparation of another serious topic that will have to do with double taxation. And when that topic is being treated in our next class, you will see how all of these things here that we're learning today will be brought to play. And that will be an exciting time when you join me in class. So at this point, I would like to ask if there's any question. If there's any question, feel free to ask. Otherwise, the class will be coming to an end at this time. So let's have your question for the next 1 minute or so. Let me entertain your question. Okay, so nobody is raising his hand to take any question. So thank you so much for coming to class. This has been an impactful one, even though the class was not as long as the other classes, but it was still impactful. So come prepared for the next class where we'll be seeing double taxation principles and how we can apply them. So thank you so much. And from me to you, I will say good night and enjoy your sleep.